the 19th of March 2025. So today I want to talk about this topic, what happens to the stock market when quantitative tightening stops, okay? So the Federal Reserve monetary policy has been a defining factor in stock market movements. As of the latest Federal Open Market Committee, or better known as FOMC meeting in January, Chairman Jerome Powell confirmed that discussions about ending quantitative tightening, or better known as QT, would commence in March, okay, i.e. this month. Now, this signals a pivotal shift in market liquidity, with expectations that the Fed will wind down QT by May, okay? Investors are keenly watching what this means for the stock market, and history provides a roadmap for the potential outcomes. So let's dive in a bit to understand a bit about quantitative tightening and its market impacts. Now, QT is the process by which the Fed reduces its balance sheet by either selling US Treasury securities and mortgage-backed securities, or allowing them to mature without reinvestments, okay? This monetary contradiction drains liquidity from financial markets, effectively tightening financial conditions. So money is actually removed out from the market. Now, the most recent QT cycle began in June 2022, after the Fed sought to curb inflation, which has surged following excessive stimulus during the COVID-19 pandemic. Now, initially, the Fed caps its monthly reduction at 30 billion for treasuries and 17.5 billion for mortgage-backed securities, eventually increasing these caps to 60 billion and 35 billion respectively. Now, over the past 2 years, the Fed has managed to shrink its nearly 9 trillion balance sheet, tightening financial conditions and causing upward pressure on yields, right? So what are the odds at the current moment? Now, this is a diagram of the odds based from this poly market. Now, poly market is a what you call it's a prediction tool based on the cryptocurrency. Okay, now the market expectations for the end of QT has been reinforced by the prediction market poly markets. Okay, so we've seen this already. So it's like 100% chance that the Fed will end quantitative tightening before May. Now, as of March 14, poly markets betting odds surge 100% probability that the Fed will end QT by April 30th, where the odds remain unchanged at the time of writing. Okay, so 19 is started, the 14 is started this already. Now, this near certainty in betting markets reflects strong investor conviction that the Fed will shift its monetary stance sooner rather than later. Now, poly market, which gained credibility during the 2024 US presidential election cycle by accurately forecasting political outcomes, is now being used as an alternative gauge of market sentiments regarding monetary policy. Okay, so to give you an understanding. Now, so let's dive in to understand a bit about historical patterns, what happens when QT ends. Now, looking at the previous cycles, there is a clear correlation between the Fed's balance sheet and asset prices. From 2008 to 2014, after the global financial crisis, the Fed launched successive rounds of quantitative easing. To be exact, or 3, QE1, QE2, QE3, each expanding the balance sheet and coinciding with significant stock market gains. So whenever there is liquidity into the market, the stock market tend to rise. Okay, So from the 2015 to 2019 QT cycle, the Fed's previous attempt at QT began in 2017 and lasted until mid-2019. So as liquidity drained, the market faced episodes of volatility, including the infamous 2018 taper tantrum, which saw stocks correct sharply. However, as QT ended and the Fed reversed course, launching liquidity operations in late 2019, markets rebounded sharply. Now, 2020 to 2021 COVID stimulus, the COVID-19 crisis triggered an unprecedented expansion in the Fed's balance sheet, fueling a massive bull run in equities, as seen in the dramatic rise of the S&P 500, right? So 2022 to present QT cycle, with liquidity withdrawal since mid-2022, equity markets experienced bouts of sell-offs. Not huge ones, but there were bouts of sell-offs as the market tightened, and you can see that happening. But with expectations of a policy shift, right? So when they started cutting rates and talking about these stocks markets have rallied ahead of any official reversals already. So it's actually preparing for it. So with this market cycle down that we are seeing, and if the Fed says, you know, we're gonna continue to cut rates, right? And probably will be in June, they cut the rates or the and after that, if they were to say anything, we're ending all the QTs already. Yeah, probably you see the market temporarily bottoming, okay, from that onwards, right? So next, let's look into market expectations and future outlook. So given these historical patterns, the Fed's policy shift is likely to have several key implications. Like I mentioned earlier, increased liquidity fuels stock gains. Whenever the Fed expands liquidity or stops tightening, asset prices tend to rise. The anticipation of QT ending has already sparked rallies, even before formal policy shifts occur. Okay, we have seen that move up already prior to the current correction that we are seeing. Now, short-term volatility with rate cuts. The initial phase of rate cuts and QT cessation often coincides with financial distress or recessionary conditions, something that, you know, is hearing a lot from the media of late, right? Historically, the first rate cut have seen equity drawdowns before liquidity-driven recoveries. Now, bond market adjustments. Before I move there, just want to let you know, do you know why the reason why we're seeing all this? Because usually there is something, a catalyst that will cause the Fed to consider, why do I need to cut rates? You know, because the market is facing some problems. So when they cut rates, there is usually a problem. That's why you see the drawdowns happening before they start cutting rates. Okay? Now, next is the bond market adjustment. So when QT ends, interest rates are likely to go down in the long run, making bonds more attractive. However, in the short term, markets might be shaky as they adjust to new policy. Over time, both stocks and bonds could benefit from the increased liquidity as well. And finally, financial stability concerns. The Fed has been known to act preemptively in times of financial distress. As seen in 2019, short-term borrowing costs in the repurchase, i.e. repo markets, spiked unexpectedly, creating a liquidity crunch. Okay, correct this. As such, injections were required to stabilize the repo market. While there is no direct evidence of a crisis today, the Fed's early shift may indicate underlying risk. That means there may be some risk that the Fed is seeing right now, but they're not mentioning it. So, you know, if they talk about QT, since January, they say going to visit in March, maybe they're seeing something already. Okay. So as a conclusion, the Fed's decision to wind down QT is a major turning point for markets. History suggests that increased liquidity supports asset prices, and the S&P 500 as well as crypto markets has historically responded positively to shifts from QT to neutral or accommodative policies. However, caution is warranted as the initial rate cuts could coincide with economic slowdowns. Investors should remain vigilant for potential financial stress that may emerge before the benefits of liquidity expansion fully materialize. So, as markets anticipate the Fed's next move, the shift away from QT reinforce a familiar pattern. Liquidity drives asset prices and stock markets tend to benefit in the long run. Okay, so let's wait for that day to come, and from there we can build, nice trades and investments as well. Right. So that's the report for today.